Just as investors began to believe that the US and China were making slow and steady progress towards a trade resolution, President Trump upped the ante by announcing an additional 10% tariffs on the remaining $300 billion of untariffed goods, effective from September 1st. Now, this is a significant move, partly because it was largely unexpected, and it was an escalation in the trade rhetoric, but it's also because it's the first time that tariffs will target high-volume consumer goods, including smartphones, clothing, and toys. Now, US consumers are more likely to directly feel the effects of these tariffs because import costs are passed on. For example, a staggering 69% of footwear purchased in the US is produced in China. The impact of the tariffs also makes it more difficult for the Federal Reserve, as they balance the need to control inflation with the need to stimulate a slowing economic expansion. China, meanwhile, reacted by weakening its currency to levels not seen in over a decade, a strong show of intent that reduces the effectiveness of the planned tariffs by making its goods cheaper for the US to import. Investors will now be closely watching the Chinese currency for further weakening or for higher retaliatory tariffs from China on the goods the US imports. Since May, Nutmeg portfolios have been positioned for a more protracted trade dispute, and we retain a slightly lower weighting in equities than would be expected over the long term, having reduced our holdings in Japan and emerging markets and taking a more defensive stance in the US. However, we continue to balance the risks presented to global trade with the potential upside offered by further stimulus from central banks such as the Federal Reserve. If you'd like to read more on this topic, please do visit Nutmegonomics.